Hi, I'm Wilhelm Hertzog. I'm a portfolio manager here at RCM. Today I'm going to quickly talk to you about Discovery Holdings. Discovery Holdings has been a share in which our clients at RCM have been invested for many years now, starting in 2007. And in the January 2012 edition of the review, we gave a quick overview of why we thought Discovery made sense as an investment at the time, why we saw value in the business, and what we liked about the business at the time. In the 18 months to 2 years since the publication of that article, a lot has changed in many respects, but a lot has also stayed the same. The one thing that stayed the same is that since that time, Discovery has continued on its long path of success. Discovery has managed to harness the power of incentives to build a fantastic business in what is, in principle, a very difficult commoditized industry. And in that industry, Discovery has managed to carve itself a niche which has become quite large over time, but a very profitable niche, and has managed to build a sustainable competitive advantage in, as I said, an industry which typically doesn't lend itself to that. So from the time of the publication of our article in early 2012, Discovery has continued on this path. They've grown the business, they've started some new businesses which are very promising and very exciting. But what has changed dramatically over this 18 months to 2 year period is the rating the market is assigning to Discovery. And chart 1 in the article illustrates this quite clearly. Chart 1 shows the price to embedded value of Discovery since about 2002. And over this 10-year time period, there have been periods of time where the market has been very pessimistic about Discovery, and there have also been periods of time where the market has been very optimistic and positive about Discovery. When we first started buying Discovery shares for our clients in 2007, that was a time when Discovery had admitted failure in the US, and when the South African economy in general was starting to look a bit fragile. In that type of environment, the share price started to decline to levels which we thought were very attractive from a long-term point of view. And at the time, interestingly enough, insiders appeared to agree with us. At more or less that same time, some of Discovery's top executives purchased substantial amounts of shares with their own money, which is a nice alignment of interests which we always like in companies which we invest in for our clients. In the years since then, well, actually maybe it's worthwhile just running through what happened after we first started buying. Initially, the share price declined by almost 40% after we started buying. And it's in that type of environment where having conviction in one's valuation of a business, having conviction in one's assessment of the economics of a business becomes of paramount importance. Because in that environment, we kept on buying, increasing exposure to Discovery, as chart 2 in the article shows. And in hindsight, it was, of course, the right thing to do. But it's difficult to stomach that 40% decline, and that's what sets many investors apart from just the herd and from following what's the easy thing to do, which is to panic along with everyone else and to decide that the market is right and to sell out. Over that 6 odd years since then, the share steadily went from being underappreciated and rated fairly lowly by the market to recently being rated at record levels and being very popular. As I mentioned, chart 1 shows price to embedded value of Discovery, and of late it's been trading at record levels, the type of levels we saw in 2005, 2006, when the company was also very popular, very much in favor. And things which weighed on the share price in 2008, 2009, like difficulties overseas, introduction of national health insurance in South Africa, those things now seem to be forgotten and no longer feature in the minds of investors, and people are willing to pay very high prices for Discovery shares. And it probably comes as no surprise that because of this, we have steadily been reducing exposure to Discovery over the past 2 years or so, to the point where our clients now have a minimal investment in the shares of Discovery Holdings. Now, what's transpired in our clients' ownership of Discovery is obviously the question of, did we buy too soon? As I mentioned, after we first started buying, the share price declined by a further 40%. And have we sold too early? The bulk of our sales in Discovery have taken place at prices below the absolute highs reached most recently. Our answer to this question is no. We are of the firm opinion, and there's plenty of evidence to back this up, that it is almost impossible to time the bottom of a share price perfectly and also to time the peak of a share price perfectly. It is, however, possible to have a fairly good assessment of whether a share is cheap or expensive, and sticking to that assessment and sticking to the process of buying shares which are cheap and trading well below fair value and selling shares which are expensive and trading well above fair value, that will result in good outcomes over time. So as I mentioned, despite buying at prices which then went on to decline by about 40% and selling at prices which turned out to be quite a ways below the absolute peak in the Discovery share price, our clients have earned very good returns from owning Discovery, both in absolute terms and relative to the market. And sticking to a process, a philosophy which makes sense, and a process which implements this philosophy methodically and consistently over time will result in similar good outcomes for our clients in years to come.